Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 352nd VideoCast podcast for the week ending July 16th, 2026. Got a lot of great stuff to cover today, but as always, family first. We got here Mimi. They won the anti-wave tournament this weekend. Her team with Newport 14U did and was absolute monster of a weekend. Just want to show you this one goal of many that was blown away. The ball's going to come from here to here, so just watch this one timer. It's absolutely sick. Here we go. Boom. Catch and shoot and place. I mean, that was just beyond exciting. So super happy for Mimi, and more importantly, her team for winning the gold at the anti-wave tournament. That's me and Mimi. That's her amazing team and coaches. That's my simulator, by the way. That's how my golf game came back. If you play golf and you can get one of these set up, it's going to, I wish I'd done it when I started 5 years ago. I'd probably be below a 7 now instead of a 9.4, but we'll get there now. So all is well. Want to thank, we had 36 or something couples over this weekend. Get together at the house and Newport. Want a big shout out to Joe, who did this incredible sushi spread, Sushi by Joe. Unbelievable job. You can check him out on Instagram. And that's that on the pictures this week. Let's move out to the media. Want to thank my friend Lou Bassanese for having me back on his show as a follow-up for when I did earlier in the year to talk PayPal and Dentsply Sirona, my Sirona. We're going to listen in here.
And their knowledge. And with that being said, I don't think there's a hedge fund manager with a better track record on Wall Street over the last 3 years than the one that is about to join us now, Thomas Hayes. I would say the only thing you're not winning at yet, maybe before I hear the update, is your golf handicap versus Kevin's golf handicap. He's down to a 6. Have you broken down below 6 yet?
I have not. No, actually, I took a painful detour from 9.2 up to 12 after getting a lot of lessons. And then I just went back to what works. I'm back down to a 9.4 and probably headed to a 7. Playing really, really well lately, but I don't know if I'm ever going to be able to match Kevin with his 6. He just gets out there and whips it around with like it's nothing going on.
I know, without a driver, but it's amazing. His driver stays in his garage for a decade plus. But let's talk about, we're talking about performance. You are turned around, Tom, for a reason. I mean, going into this week, PayPal was down, nice double digits, and now it's flat from where you recommended it because there's a takeover offer. What do you think about the valuation offered in this buyout? I think it's $60.50 a share was the price that was offered. Way too low. Where do you see this playing out from here?
Absolutely insulting, despicable offer. It's got to come higher. Look, we after we were on your show, they had a surprise change of CEOs. It sent the stock down to $39, and we bought hand over fist. We brought our basis down across all accounts to the low 49s. So look, we didn't get into this thing for 20%. We got into this thing for a 3-bagger, 200%. And they come in at $60, which is like a 12% free cash flow yield. We bought it with a 17% free cash flow yield, and that old dog don't hunt. So they're going to either have to sharpen their pencils or go away, because the company's hitting on all cylinders. I mean, record revenue per share, free cash flow per share, earnings per share, record low multiple. So historic multiple 18 times, current multiple 9 times. And the reason was because the lower margin business, which is the Braintree, when you get it in an Uber, you're paying PayPal through Braintree. When you buy tickets, you're buying a through Ticketmaster, you're paying PayPal through Braintree. You just don't know it. And that business grew exceptionally fast, $1.7 trillion of transactions, 90% of the Fortune 500. And branded grew more slowly. So that brought margins down. That was the bear case. But now margins are inflecting back upward. The turnaround is just getting started. And if they don't do this deal,
fundamentally, they're in a much stronger position to just reject this takeover offer. It's not like
100%. Anything below an 8 handle is insulting, and and must be rejected by the board. And anything between $80 and $100, like, you could take it, but you're still stealing, $50 to $70 of upside from the current owners at that level. If we're just to, keep executing the turnaround plan as they are, Venmo growing 20%, buy now, pay later growing 20%.
Right.
The ad business just coming off its nascent stages. Mark Grether, who built the ad business for Amazon, 50% of operating income. Most people don't know that. He's building the same thing for PayPal, which has tremendous amounts of data over the last 3 decades. So a lot of outs. I think the net effect is either Stripe will come up, maybe not enough, but I think it's going to invite other bidders to the table and
run a full process and get it up higher to a valuation that might be a little bit more palatable.
Yeah, but I think the best case scenario is they just keep executing and doing what they're doing. But if someone's going to take them out, it better be a high number, 80 to 100 plus. And the obvious buyer would be Elon Musk.
Yeah, no, agreed. Going back, right, was he one of the original PayPal mafia? So getting it back in his portfolio there. Quick question for you before we move on to Dentsply, X-Ray. I'm noticing a theme with you. You like stocks where the fundamentals are undeniably undervalued, right? Fundamentals are near an inflection point, turning point. But I'm also sensing you find management executives that have had success at another company that have now ended up, you talked with here at PayPal, a guy that came from Amazon. We talked about your favorite pizza stock and the digital guy that turned around Domino's is now over there. Is that part of your investment discipline to find proven executors that move to new opportunities to extract value?
I mean, generally, you don't want to hire the arsonist to put out the fire he started, right? So, there are a few exceptions. We had Jeff Edwards at Cooper Standard when we bought. I think it was around 4% of the company at $5 a share, and he oversaw the company share price drop from 146 down to 5.
Yeah.
But he was the right guy. He was the right operator. These were exogenous events with COVID and other factors, and he's done a great job turning it around. It's a $30 stock now, probably going to 100 over time. Once we get to peak cycle autos, average car on the road, 14 and a half years, more licensees than ever, more road miles than ever. So that replacement cycle, they've got a massive amount of operating leverage. We think they can earn $10 a share at the top of this cycle. They earned $7 a share when it was trading at 146. So that was the exception. But usually with turnarounds, we want someone who has a proven track record. With VF Corp, we've got Bracken Darrell, who did a 26 bagger at Logitech, and now at Dentsply, we've got Dan Scavia, who came from Globus Medical. He had a 4-bagger there as chief commercial officer, and then finally CEO. So
where do you see the upside for Dentsply here as this turnaround gets some traction? What's the latest developments, and then kind of what's your latest estimates of where we get to?
Yeah, it obviously all opinion, not advice, but we don't get into these things unless we see at least a 2 or 3 bagger over 3 to 5 years. In the case of Dentsply, I think it's going to be more. They've been around, both Dentsply and Sirona. They've merged in 2016, which they didn't do it right, but blah, blah, blah. They've worked through that. These are, century-old businesses, and the issue you have with the dental industry, it's usually a GDP grower, very stable, mature business. Dental visits are still below pre-COVID levels. So like autos having the average age of a car 14.5 years on the road, it's deferred pent-up demand that eventually will get resolved because you have a 14, 15-year-old car. Sooner or later, you're driving down the highway and the axle falls off and the transmission
and busted
breaks.
Teeth need fixing eventually.
Yeah, and so that's going to happen. Aging population, more people into vanity dental, and they're the leader in chair-side milling. So in the old days, you go to the dentist, they take a molding of your tooth, and then you come back in 2 weeks and come back in another 2 weeks and come back in another 2 weeks, and 80,000 appointments to get one tooth fixed. And now you get there They take a laser of your mouth, they put it in the machine, it prints out a tooth, they stick it in your mouth, and you go home, and it's done. And so they're a leader. And Dan Scavia, you know, the previous management just were completely brain dead. They did a Nike play. Nike said, "Oh, we're going to be all DTC. We're going to screw our wholesalers," and that worked out really well. The stock's down 80%. With Dentsply, they did the same thing. Scavia comes in, and he immediately reestablishes the relationships with Shine, with Patterson, with Atlanta Dental, restores that, gets distribution going. All the fat is cut out of the business. Everything's hitting on all cylinders. And he's even talking about buying back stock towards the end of the year, return to growth. Yeah. He's got it firing on all cylinders. So we love this story. What do we think? We think this could be $50, $60 stock again. It'll take a few years, but there's huge operating leverage, huge pent-up demand, and it's got a huge moat. Ask any dentist if they've ever heard of Dentsply Sirona. They'll be like, yeah, it's the best in the business. What else do you want to talk about?
Yeah, exactly. It's the most well-known. I'm not even going to ask you about SpaceX because you're the deep value guy, and there's no way, no metric, no model you can put on it that even says it's remotely undervalued. Am I wrong?
You're right. I mean, look, you never bet against Elon Musk, but there are some things you got to know. You know, Thoreau said, "Know thyself." You know, I operate in an area that I have an edge. I buy good businesses at great prices and get doubles and triples. You know, people want to bet on the future and guess the future. I'll leave that to them. You know, objectively, it's a company doing $18 billion of revenue, losing $5 billion of cash, trading at 100 times sales. So, you know, was when everyone wanted it at 220, now at 133. No one's talking about it again. All the people that were pushing it at 220 have disappeared off their Twitter accounts. And, you know, so at some point it makes sense. I think that, you know, it's well below 100. You really have to believe you know, Starlink is awesome. It's for rural, it's for areas that, you know, but you're never going to beat fiber in terms of delivering, you know, but it's an enhancement. It will have some impact on the mobile business, certainly in dead spots where there aren't towers, et cetera. And, you know, as far as setting up data centers on Mars, I mean,
there's some physical challenges there that I think everyone's just being Pollyanna about, like, oh, it's no big deal. We got, you know, you don't have to worry about cooling in space. Yeah, actually you do. The physics require, you can only dissipate heat in 3 ways: convection, conduction, or radiation. And radiation is the only available way to do it in space. So you have to have huge surface areas. So I just love the fact that even a stock that you would never go near, you know all the fundamentals on it and why you wouldn't go near it. So appreciate.
Yeah, I mean, look, there's always a price for something. You'd like to buy a little bit of Elon Musk, but there have rarely been instances where there was an opportunity to buy it at a price that makes sense. But I would just say it's a lot lower than here. So I never rule anything out, but it just won't probably ever fit in our framework, and we're okay with that. And we hope a lot of people make a lot of money on it, but we won't be one of them. Understood. And you're doing just fine without it in your portfolio with your framework, man. So kudos to you always. I told people in this contest, until this thing is done, until we turn the clock at the end of New Year's Eve to 2027, don't count and don't bet against you, because your stocks, when they turn around fast and they get moving. So appreciate you sharing your insights. You can find more if you're listening, hedgefundtips.com. Tom Hayes, always a consummate professional and the best golfer that I know. Thanks. Appreciate that. Thanks, Lou. All right, brother. Talk to you soon. And we're back. And then I had the privilege to join Joel Elkinen on the Stock Trader Network. Always does incredible interviews, long form, thanks to Zoltan Saranya as well. We're going to listen in here.
Good morning, folks. Welcome to our continued programming here on the Stock Trader Network. We are joined by Tom Hayes, founder of Hedge Fund Tips and Great Hill Capital. And we could sure use some hedging tips. Tom, how you doing today? I'm doing great. All right. Well, our shows today, we're just trying to figure out why this market won't go down. We we've had our leadership kind of falter, but they seem to be picking up the slack in every other place here. So just wanted to, before we get into your slides here, your presentation, just wanted to get you feeling like the sky is falling, but no, it's not.
Yeah, I think that it's playing out according to plan. I mean, I think the last time we talked, I was talking about semis and memory being the most crowded trades and start to kind of lay out of that and layer into everything else. The everything trade would come back after the memorandum of understanding. Well, the memorandum's blown up, but the trade is still working. Get the hell out of semis and memory and get into everything else. And we saw the signs of the froth, record retail call buying, record margin debt, everyone chasing the shiny objects. And what'll happen here on these pullbacks with memory and semis is everyone's going to continue to say this time it's different, it's secular, it's not cyclical. Every time they say the exact same thing, and they're going to buy every 10% downturn. They're going to keep buying down until they blow up their accounts. And it's no different this time. I talk to super smart people, whether they've just sold their business for $500 million or they're trading a $20,000 retail account. It's the exact same story. They can't help themselves but buy everything that's in the news, whether it was SpaceX at $220 now trading below its IPO price, whether it was Micron telling me, trying to convince me that it's trading at 9 times earnings. And the key thing that people need to understand is the difference between peak earnings, trough earnings, and normalized earnings. So some of the my nickname on Wall Street, as you know, is Turnaround Tom. We buy businesses that are out of favor and we sell them at doubles and triples after a few years. And, whereas a lot of people like to buy what's in the headlines, we like to buy what's forgotten, and we like to sell when they get into the headlines. So, we had bought Intel between 19 and $21. We were sellers at 96, 97. It went to 140. Well, guess what? Today it's back to 97. So, people say, why didn't you hold on? Because we knew where we were going to get out before we got in, and we stick to that discipline. I think, as it relates to the Microns of the world and the SanDisk of the world and the Lam Researches of the world, and all these companies, they're all down 25% in the last 2 weeks. Some are down 30% in the last 2 weeks. And they're going to keep going down because we've seen with the hyperscalers that they've kind of exhausted their ability to maintain such high capex commitments, whether it was through the debt markets. Yes, credit spreads are still tight. They can, in theory, still borrow, but their capex as a percentage of operating cash flow is basically at 95%, 100%. So they're borrowing debt. Some of them started issuing equity. They're all doing these hybrid converts to raise capital. But the real problem, Joel, is that the businesses that just got whammoed in the first and second quarter with huge token charges cannot yet translate that into productivity gains. So all the managers are saying, find cheaper models or lower token usage, which is why the Chinese stocks are up like crazy in the last few weeks, because people are realizing they can get tokens for much cheaper. They can get the LLMs for much cheaper. And if that's the case, the amount of capex that these U.S. hyperscalers are going to stick to is going to greatly diminish. And what we're going to see in the case of the Microns of the world, where people think they're trading at 9 times earnings, they're going to find out that the earnings is fugazi, because as every 4 years, if you look at Micron's chart going back 40 years, every 4 years, there's a memory shortage. Every 4 years, Micron increases capacity just in time for demand to subside. This time is no different. And people say, well, that's not true. AI is secular. It's just getting started. We agree that AI is secular. We agree that it's just getting started. We don't agree with the idea that businesses are going to pay up for maximum token price prospectively. We're going to find technology is going to move things in a direction where you can get more for less, just like we saw with the quote unquote deep seek moment, when all of a sudden GPUs, people couldn't get enough NVIDIA stock. And what's happened for NVIDIA for the last 2 years? It's underperformed everything else. It went sideways for a year and a half. because they say, well, we could do it with CPUs, we can do inference. And the same will be true with the tokens, whether it's using China models, whether it's China starting to flood the market with memory. The 9 times E, the E is going to prove to be wrong. And in 2 years, you're going to realize that you didn't buy Micron at 9 times earnings, you bought Micron at 400 times earnings.
Yeah,
you got faked out by peak earnings versus normalized and or trough earnings.
Right. So looking at your graph here on CapEx growth, deceleration, I mean, you're already seeing it, right?
Yep.
Q1 to Q2 was the bump, and that kind of freaked everybody out. But here's here's your projections for Q3 and then coming down in Q4. So I mean, these companies just can't continue to spend like this unless it's somehow showing up in the bottom line, correct?
Yeah, that's exactly right. And we saw the first shot across the bow with Meta a few weeks ago, which started the sell-off, which said basically we're going to resell our excess computing capacity. What is quote unquote excess computing capacity? What that means is they have determined internally we can get a higher return on invested capital by selling off this compute as a commodity, competing against other companies that are selling off this commute as a commodity, aka we're going to just be a reseller of GPUs, versus if we use this capacity internally, we can generate a higher return on invested capital. So what they effectively said indirectly was, we're not getting a return on our AI investments. We're going to sell it to you schmucks who are going to try and get a return, but it's not meeting our expectations. And you're going to see that from more and more hyperscalers. And I do think the last time we spoke, because it's been a theme of ours for 2 months, as I said, in Q2 earnings, you're going to see some of these hyperscalers moderate their CapEx commitments. And when you have stocks trading at 100 times sales, or in the case of the semiconductor basket, 20 and 30 times sales, when these things used to trade at 2 times sales, and demand goes down 1% or 2%, the stock doesn't go down 1% or 2%. The stock goes down 75% because they're cyclical. They always have been. They always will be. Newsflash for those who haven't read a history book.
Can you go into detail? You said sometimes cheapest stocks trade at 100 PE on trough earnings. Can you explain that?
We've made our knitting. You know, it's funny. People say, well, Tom, aren't you kind of like a value manager? I said, yeah, I think so, except for the fact there's no correlation between our returns and a value index. If you bought a value index in the last 15 years, you made nothing. Like, you dramatically underperformed, and yet we've done very, very well. And why is that? Is because we buy businesses that are out of favor, but we also buy them with a catalyst. And we have a framework that we look through to ensure we got the right jockey, solvency risk, the jockey risk. Is there a catalyst to change? Not cheap for cheap's sake. And the key that you're pointing to, Joel, is some of the cheapest stocks we've ever bought were trading at 100 times, which no value investment manager it takes advantage of, because they miss them in their quote unquote filters, their lazy work to try to find low PE stocks that are going to be low forever. They're buying B&G Foods, which is, bottled pickles. Who the hell is going to, what's the catalyst there? It's going to stay cheap forever. It's a bag of, what. So as it relates to buying businesses at 100 times that are cheap, it's because we buy businesses that have been around forever, decades, so we can understand how they operate through different cycles. And the fact of the matter is, if we look and we see, well, normalized earnings for this business is $2 a share. We happen to be in a recession, or we're in a cyclical trough in that industry, whether it's Albemarle doing lithium when we were buying at $59 rather. But the fact of the matter is, we can look back and we can say, yeah, this thing, it's a 5% grower. It's, in a normal cycle, they're earning about $2 a year. The next year they're earning, $2.10. The next year they're earning $2.15. Next year they're earning $1.90. The next year they're earning $2.30. Oh my God, why did they earn 2 cents this year? Uh-oh. Okay, so now you were trading at 10 times the normalized $2 of earnings. Earnings drop in a recession, let's say for a cyclical, from $2 down to 2 cents because they kitchen sink the quarter because they're in a recession. They set the stage for the next cycle. So at 2 cents of earnings down from a normalized $2, your multiple goes up to 100 times. And people say, oh my God, why would I ever buy that stock? Is so expensive. It's trading at 100 times earnings. No, it's trading at 100 times aberrational trough earnings at the down point in the cycle. When the cycle resumes, whether it's a recession or the industry gets back into favor, it's going to go back up to $2.10 of earnings, and you're effectively buying it at 10 cents. The difference is because earnings dropped from $2 to 2 cents, the stock went down 80%, even though the normalized earnings are going to be $2, and you're able to buy it in the hole and make a ton of money while all the other value investors miss it because it's quote unquote trading at 100 times earnings. We know normalized earnings are $2. Just like everyone now thinks, what has everyone been saying for the last month? NVIDIA's so cheap. It's trading at 5 times earnings. It's trading at 5 times peak earnings. Okay. They sell a commodity product that the Chinese are going to flood the market in, and just in time for there to be less demand, because there'll be another DeepSeek that shows how to use AI to get actual productivity results in businesses. So am I super excited about AI, how it's going to change our lives and increase the standard of living for everyone? If the robots don't kill us, yes. Okay. If the robots kill us, it doesn't matter. But if they don't kill us, I think life is going to get really, really good. So I'm super excited. But I was, it's 2000 Amazon was a super exciting time to be investing in Amazon because they said they were going to become the store of everything. They were selling books on a crappy 1.0 web 1.0 website with ugly links, and they said we're going to change the world. And you know what? Everyone believed them. The stock was trading as if they were going to change the world. And guess what? 15 years later, they delivered everything that they said that they were going to do and a ton more. We didn't know that AWS was coming. We didn't know that the ad business, which is 50% of their operating income, was coming. We didn't know that all these other Amazon Prime that was going to put Costco membership to shame was coming. All these things and more were coming. So in 2000, you bought the stock. Of course, you bought the stock. They were going to change the world. And they did. You were betting on Jeff Bezos. Here's the problem. In 2001, earnings per share went up. Revenue per share went up. Cash flow per share went up. Guess what? Stock went down. 2002, revenue per share went up. Earnings per share, cash flow went up. Fundamentals continue to get better. The stock was down over 90% peak to trough from 2000 because you bought at the wrong time. Your price is what you pay, value is what you're going to get. You can believe the AI story, but if you're paying as if it already happened, what you think is going to happen 15 years from now, and you're already paying as if it happened today, I guarantee you're going to wind up in a 50 to 90% drawdown. It's just like people paying at $220 for a business that was making $8 billion in sales and losing $5 billion a year. They're paying $1 trillion because in 15 years, Musk is going to quote unquote cool down Mars so we can be up there in space. Maybe he will cool down Mars and maybe we will be up there in spacesuits in 15 years. But let's wait and see. You're paying as if he already did it yesterday and it's not feasible, and then you get these other guys out who know what they're talking about that say data centers on Mars don't make economic sense. Maybe Musk will prove them wrong, but do you pay as if Musk is right for what he could potentially do 20 years?
Exactly. Yeah. Talk to me about this bull bear indicator from Bank of America. How long has it been stuck at the extreme bullish in the 9.5 reading? And then throw that in, in conjunction with where retail investors are sitting at with cash and where that cash may go.
Yeah. So look, this is from Bank of America. These are not the periods where you want to be an aggressive buyer of the most crowded trades. And we're seeing the effect of that with basically the semi and memory basket down 25 to 30%. month to date, okay? Not year to date, not cycle to date, month to date. We're set 16 days in, and many of those days were holidays. So we're basically like 10 trading days in. So so this is showing that things are a little overheated, and they're particularly overheated in those crowded areas. And that, to your point, you started this out saying, the market won't go down because the money is moving out of the crowded areas and into everything else, and valuations are starting to matter again. I think yesterday was an opening salvo with the offer for PayPal, left for dead stock, the largest position in our portfolio. And we bought that at a 17% free cash flow yield. Like, you don't have to be brilliant to do these things.
What's your thoughts on that? Is 60?
I think it's an insulting offer, and they should reject it. And they shouldn't consider anything until it's got an 8 handle in front of it. And even then, I'm getting robbed probably another $60 of upside over the next 3 years out of my stock. But I'll live with it because there's a time value of money, and I'll take the double and move on. But as far as the business is trading at 8 times. They're reaccelerating margins. They're near record free cash flow, record revenues, record earnings. It's the Wall Street fashion show. It just doesn't have. If they called it AI PayPal, it would be trading at 25 times. It's just not. So they'll come back into favor. And the move that you're seeing out of semis and memory and into everything else is because valuation is starting to matter. And you're seeing a company like PayPal generating record free cash, trading at 8 times earnings, all of a sudden get a buyout offer at a 30% premium to market. It's the beginning days, and you're going to see animal spirits start to say, well, let's stop buying these things at 100 times sales that are losing money, and let's start buying these things that actually make us money. Because as investors, the only reason we give $1 is we expect more dollars back in return. We can't buy anything with promises. I can't go to Ralph's and buy blackberries with promises about getting on Mars. I can buy it with free cash flow. And when I can buy that free cash flow cheap when no one wants it, I can outperform over time.
All right, this chart 10 here. What's this telling me? Back in March of 2020, this is large cap growth versus U.S. small cap value, price relative. You hit that peak right around COVID here, March of 2000. You're looking from that November 25, hitting that same level. Give us the implications of chart 10.
Yeah. So the previous peak, that's going back 26 years to the tech peak in 2000. That's not the COVID peak. So
right.
That's the
Okay.
Tech peak. So we've had a kind of a theme here that there are a lot of similarities to 2000. I don't think we're going to get a NASDAQ tech wreck like you got in 2000. And I don't think we're going to get a material aggressive indices pullback. The S&P was down 55% in 2000 to 2003. The NASDAQ was down 80 or 90%. I don't think we're getting anything like that. I do think that, these overheated areas are going to get even more shellacked than they have been in the last 10 trading days. But the theme coming out of that as valuations start to matter is going to be, and we've been ardent table pounders on this for some time, value will start to outperform growth. International will start to slightly outperform domestic. That's going to be a multi-year theme. Small cap will start to relatively outperform large cap, and everything that's been crowded will underperform. So you've already seen the first phase of that with the Mag 7 turning into the Lag 7. We were pounding the table on that in late 2004, late 2000, and then 2005 to early 2025 to early 2026. Mag 7 has underperformed. And now the second phase is this crowded trade is going to underperform the semis that people can't get enough of and the memory. So where does that money go, and why are the indices holding up, to your point? It's going into prices what you pay, values what you get. People are going to want to get something in exchange for their investment dollars, and that's going to be free cash flow, reasonable multiples, and the beneficiaries of AI, which will be everyday Main Street businesses like industrials, manufacturing, it could be consumer discretionary, all these businesses optimizing with the magic of AI to increase their margins are going to be the bigger beneficiaries than the CapEx hoovers and spenders that people have initially crowded into and now are beginning to underperform and will continue to do so.
All right, get away from, bet on the consumer here. Consume,
Yeah.
consume. We got some nice looking charts here. Lowest FMS allocation to consumer stocks since May of 2006. You see what happened there. Also, we're looking at consumer discretionary bottoming versus the S&P 500,
Yeah.
the great financial crisis, COVID, and now we're back in that area again. So give us the information on what we're looking at here.
Yeah, never bet against the U.S. consumer when they have a job. The issue has been consumer confidence at multi-decade lows. That is starting to turn up. That's a direct correlation to inflation expectations and concerns about jobs. So you had the AI fears. Now people are realizing AI is useful, but it's not really wiping out tons of jobs. There have been a couple companies that came out and wanted, overhired in COVID and wanted to lay people off, and they blamed it on AI. But like at the end of the day, they were just kind of inventorying labor during COVID when they couldn't get any of it. And then when they realized labor is now abundant, let's get off. Let's let go of some of that inventory. And consumer confidence is inflation expectations. So, the war started to end until it didn't. Inflation expectations came down as oil came down. I think, there'll be fits and starts here with the war, but, as November rolls forward, Trump's got to kind of get this thing in a container. So either hit them all in all at once over a weekend after 5 o'clock after the market closes and get it done, or just put it on the back burner until November 9th. But in that context, and gas prices have come down, consumer confidence, inflation expectations have come down, consumer confidence has come up. People still have jobs, 4.2% unemployment rate, and that's when you want to bet on consumer discretionary when they're this out of favor, which you haven't seen since COVID and the great financial crisis. And we're not in any economic periods that remotely resemble that. And some of the companies have really been beaten down where you can find a tremendous amount of trough value. Okay. So PEs may be high, but prices down a lot, and they'll get back to normalized earnings power and make you a ton of money.
All right, let's get to these 6 consumer plays here that you have on your radar. We've heard some talk about Baba, but just run us best case scenario on these 6 issues. Alibaba.
Yeah, Baba has been it's the cheapest AI play in the world, number one. It's a play on the recovery of the consumer in China, which, had been locked in and soldered into their apartments just a few years ago due to COVID and bad governmental policy. That's thawing. The spending is starting to come back in China. But more importantly, you see that all these IPOs going out in China, people are finding out that, oh, wait, Alibaba owns 10% of that. It's worth $20 billion. And it was never priced into the model. So what Alibaba did during COVID, when all of these startups, AI startups, were asking for compute but didn't have any money, they said, oh, hey, no problem. We'll give you all the compute you want. You're going to give us equity in your company. So Alibaba inadvertently became an AI ETF for Asia because they own big slugs of all of the best AI companies in Asia. And now those companies are starting to go public because the mainland stock market is hot, and Alibaba is monetizing a lot of those stakes, and that's going to be very accretive to earnings and to the company's firepower to continue to invest and stay ahead. Their AI business and cloud business growing at triple digits for the last 13 consecutive quarters, and it's the best way. They're a toll taker on the recovery of China. 40 cents of every retail dollar, online dollar goes through Alibaba. So we like that story.
Diageo. What do you, people gonna be drinking? Oh, that's an ugly looking chart there. Talk to us about Diageo.
ugly. It makes me smile so wide I could eat a banana sideways. I can't get enough of this. I'm licking my chops. So look, everyone thinks the GLP-1s no one's ever going to drink again, and the answer is they're doing $3 billion of free cash flow. You can't give this stock away. Every region except the United States is growing at double digits. Whether it's Africa growing at 16%, they've got Guinness. They were just the number one sponsor of the World Cup. So they're rationalizing the business. They're getting rid of a bunch of middle management cost layers. Drastic Dave, who turned around Tesco's, running it, and he's bringing some discipline in. Sales have been flat, but they're not declining outside the U.S. U.S. got hit by a tequila glut, and they're working through that. This is a long-term best player in the spirits business. People are drinking less, but they're drinking better, higher margin stuff. Diageo's the king of the high margin stuff. This stock is going to be fine. And if you remember, after cigarettes got out of favor, some of the cigarette stocks, as the business is consolidated, became the best performers over the next 2 decades, and Diageo will be no different. So if you really have a bearish view on alcohol, you want Diageo because they're going to be the last man standing. If you have a more reasonable view that it got overdone during COVID, they had to flush out the excess, and now they're back to normalized operating, you want to own it, and that's kind of our view.
House of Mouse.
Yeah, this one you can't go wrong. The new CEO, he ran experiences. They're investing in the highest return on capital businesses, which is the cruise ships, the experiences, the parks, 20% greater return on invested capital. I saw some dumb analyst out the other day and said this thing could really double if they would just get rid of streaming. They've spent 3 years investing in streaming. The thing turns cash flow positive. Now it's starting to generate massive free cash flow. They've bundled it with ESPN, which everyone wants and needs. And it's just starting to be a huge hockey stick player. As a matter of fact, if you look at the Netflix multiple relative to the Disney multiple and relative to the user growth in each and the opportunity in each, like Disney could be a triple on the basis of streaming, not getting rid of streaming but that's what makes the sell side stay at the sell side. We love this story, and we think, over the next 3 years, this new CEO is going to deliver. Look, they're coming off $10 billion of free cash flow. You can't give the stock away. Record free cash flow. So as valuations start to matter again, as everyone gets hurt in all these, fugazi earnings or no earnings stocks that money is crowded into in the last 6 months, the ones who have accounts left are going to start to buy things that price is what you pay, value is what you get, where they're getting some free cash flow for the dollar that they invest and some steady, predictable growth.
All right, Etsy, looking at the shorter term charts, a heck of a rally, but looking at a longer term chart, maybe this rally's just get going in Etsy. Tell us your reasoning for liking this stock.
So they, like all these internet platforms, whether it's PayPal, whether it's Etsy, whether it's most of them peaked in COVID 2020 when you were paid money to stay at home and shop. So obviously, that was a once in a lifetime opportunity. So all these things have come down 80%. This one's moved a lot in the last 3 weeks. They've gotten a new CEO. She ran growth for Depop, which was the fastest growing division. She's now running the entire company and applying those same growth principles to Etsy. And I always say, if you're going to give someone, if you want to do the minimum, order someone chocolates on Amazon. If you want to get them something special, get them something custom on Etsy. Etsy is the biggest, unique, custom crafted gift platform in the world. It's got a complete moat around that. And they're back to growth. They've really upped things with the app, with the loyalty, with the rewards, with the quality of the offerings, with the curation, and she's doing a great thing. Oh, and by the way, the stock's down 80%. These are my favorite stocks. Stock down 80%, and at or near record free cash flow, record revenues, record users, and you can't give the stock away until you can, because it's the Wall Street fashion show. And, for 3 years, payment processors and online platforms have been out of favor because people couldn't get enough of them 4 years ago during COVID, when everyone wanted them, and they'll be back. And people buying them now, and as they look 3 years out and they double and triple their money, they're going to be excited. So Etsy's one that, we have below 50. This thing's moved up, 70% in the last couple of months. It did nothing for a year and a half while we were building our position.
So you think people are going to be buying their North Face and their Vans and their Timberlands here? You're looking at VFC. Is that where the consumers are going to be spending some money?
No question about it. So Bracken Darrell came in as the turnaround specialist. This business was over leveraged. So again, another retail consumer thing that was hot during COVID collapsed. North Face, Timberland hitting on all cylinders. They sold off Supreme to pay down debt. They sold off Dickies to pay down debt. The balance sheet is now deleveraged. All the brands, 3 out of 4 brands, they've got this Ultra, which is the number one running shoe for, like, I don't know, people who run in the woods or something. I have no idea. The thing is growing at 50%, and hiking people and those type of people. The one that's weighing them down is Vans, which fell 50%. Okay, since 2022, they brought in the chief design person that was part of Lulu's major success when they were successful in terms of designing. And she's brought a lot of cool stuff to Vans. She's doing a lot of higher end stuff that's selling like crazy. If you remember a few weeks back, they had that Satoshi thing that people were outside Fifth Avenue, punching each other to get the last pair. So that, that was good and bad at the same time. They're doing collaborations with super high-end French designers. I think anyway, it'll come to me. It's not Versace, but it's of that ilk. The key is it's back to growth. And if you bet on Bracken Darrell, his last turnaround he's a turnaround specialist. You got Logitech. He came in when the stock was down 83%. If you put $1 million in when he became CEO of Logitech, 7 years later, you had $26 million, 26 bagger. He's doing the same playbook at VF Corp. I don't think it's going to be a 26 bagger, but it is going to be a multi-bagger from our $12 or $13 basis. And, this will be a $50, $60 stock a few years out in our view, because Vans, all the others are growing. Vans is now bottomed and starting to return back to growth. The comps are now in the rear view mirror, and I think that's going to be a monster.
All right. People are going to be taking care of their teeth here through.
I love it.
Yes.
Dentsply Sirona. I call it my Sirona. If you remember my Sharona, so it's my Sirona. This thing
you remember the band that's saying that?
The Shank. What are they called? The Sank or the Shank or.
No, the Knack.
The Knack, exactly. The
Okay.
Knack. Yeah. So anyway, my Sirona, this thing is a beast. Dentsply and Sirona have been around since the late 1800s. Both of them, they did a merger. They stood up 2 drunks together in 2018. Rather than being able to walk out of the bar, they both fell over due to mismanagement. But they still are the leading dental supplier. They do the chair side milling, the CEREC machine. So you used to walk in, they'd take a picture, they'd send that picture to some lab out in California. That lab would make a tooth, they'd send it back, and you got to go back in 2 weeks and put it in. Now you sit in the chair, they print the tooth, they stick it in your mouth, you go home. And they're the leader in that, as well as all the other things that they're putting in your mouth while you're waiting for your tooth, from the that silver shiny mirror to, everything that's in the dental chair, in the dental office, they supply. So why is the stock down so much? Number one, mismanagement. Number two, dental visits are still below pre-COVID levels, despite demographics being more favorable, AKA people are getting older, their teeth are falling out, they need care. And the other thing, people being more interested in looking better with their teeth, and shinier teeth and better looking teeth and veneers and all that stuff. And yet visits are still down. So I call that deferred maintenance. Okay. It's like you have a 14-year-old car, Joel. Yeah, you can get away with it. You think everything's going well, but sooner or later it hits the wall and the tranny goes out. Like, there's a life cycle to not maintaining your cars. There's a life cycle to not maintaining. So there's a lot of pent up demand in the dental business. So that's number one. Number two, key thing in our turnaround Tom framework is the jockey. So they just got a new CEO in who knows what the hell he's doing. He came from Globus Medical. He was there for 10 years as a chief commercial officer, then chief executive officer. The stock was a 4-bagger during his tenure. He's bringing that rational mindset, normalizing costs, getting back to growth. Oh, and by the way, the last genius leadership, they cut off all of their distribution relationships with Patterson, with Shine, with Atlanta Dental, because they wanted to go all direct to consumer, just like Nike. These idiots go to Harvard Business School and they come in with these stupid ideas and it blows the business up. And then you got to get a normal guy who went to a state college to come in and clean up the mess and make money again. And that's exactly what's happening with Dan Scavia. I don't know where he went to college, but he's doing all the things that you would do, Joel. You would walk in and say, costs are out of control. Oh, and by the way, we'd like to see some sales. So let's renew all the distribution networks that the idiot cut off. So they've got their relationships back with Patterson. They got their relationships back with Shine, Atlanta Dental, several other distributors. So that's in case. They've taken a couple $100 million of costs. And the reason we got involved is we noticed they were paying like a 7% dividend. I was like, wow, this is 125 years, $125 million a year of free cash flow. Imagine if they cut the dividend, they could reinvest that in the business and turn it around. Well, they did exactly that. So now that $125 million is going into R&D. It's going to be going into buying back stocks. The CEO implied he'd like to buy back stock at these levels, and the business is turning around. This will be 40, 50, $60 3 to 5 years out. In our opinion, not advice, but we're putting our money where our mouth is. This is a big position for us, and our basis today is $11.22 across all accounts. We think it's going a lot higher.
Are you a horse racing fan at all?
No.
Oh no, because you mentioned jockey.
Yeah, no, jockey is. Yeah, I'm not. I'm not
a leader. Well, I will say one thing.
I'm not a gambler Thomas, at all. I bet on sure things.
I will say one thing. Yeah. Except for the Etsy chart.
Yeah.
All your charts look pretty much the same.
Exactly. That's when we buy.
Yeah. Yeah.
That's when we buy. We buy when no one wants them, when all the technicians are puking them out because they broke. Where we really love is when they break downside support and all your stop losses get hit. And that's when we're just hoovering it up like a pig. Just like Baba at $60 when it broke support at 58 and Morgan Stanley downgraded in the hole. And over the next 8 months, it went to $190. So we live for this stuff, just like the majority of people are buying the quote unquote breakouts. Okay. We're buying the breakdowns because we know we can make our doubles and triples over 3 to 5 years, provided it meets our framework. It's got to generate cash flow. It's got to have a good jockey. It's got to have a safe balance sheet. All of those things that go into the framework. But for us, we bet on sure things. Solid, predictable businesses that have been around a while when no one wants them and everyone's saying the chart looks bad. It's telling us something. Yeah, it's telling you it was mismanaged, but is the moat impaired? And if the moat's not impaired and people are still going to get their teeth fixed, they're going to give Dentsply Sirona a lot of business, and it's going to be my Sirona at $50, not at $11.
All right, we are going to wrap things up with Tom Hayes, founder of Hedge Fund Tips and Great Hill Capital. We're gonna throw you at the pre-market prep crowd and let you throw some of your ideas at them. So thanks for being with me today.
All right, thank you. And we're back. And then finally joined Scott Shellady. You may know him from Fox Business. He's on all the time. He's got his own show. And it's this network, RDN, that services farmers. It's got a huge following in the center of the country and really amazing audience. So we're going to listen in here.
All right, welcome back. My next guest, I'm excited about this. He's a longtime listener, first-time caller, right? You see him every day on a lot of the other news shows, and he's been kind enough to a degree to come on ours today. His name is Thomas Hayes. technically he's a financial expert. He's also better known as the chairman and managing member of Great Hill Capital LLC in New York and host of the Hedge Fund Tips with Tom Hayes podcast. That's how we bumped into him. And that's also, I see him a lot on Fox Business too. So we wanted to introduce him to our viewers and get his macro take on interest rates, inflation, the latest CPI and PPI numbers as well. So where does he see monetary policy this year taking us, and what will that ultimately do to our stock portfolios and maybe our 401ks? So without further ado, let's get him on the show. Please welcome to the show, Mr. Tom Hayes. Tom, thanks for taking the time, brother. Really appreciate it. Okay. Last to unwrap real here quick. It's going to be a short segment. It'll go fast. But CPI, PPI, inflation obviously abating, gas prices coming lower. What are your thoughts here macro-wise, and how does that drive us into the end of the year?
Yeah, listen, we love to see the inflation numbers coming in lower than expected. You know, one of the things that the economy struggled a little bit with was consumer confidence was at multi-decade lows for some time. Now that you have the memorandum of understanding, and yes, it's fits and starts and bombing and non-bombing and all that stuff, but generally speaking, energy prices have come down. Certainly, we saw that in the inflation numbers last month. We have an election coming up in November, so the administration is going to want to get this resolved either through sheer force and immediate force, or through some compromise and push it off past the election. But consumer confidence, Scott, as you know, is directly tied to inflation expectations and employment expectations. The unemployment rate couldn't be better at 4.2%. There was a little concern earlier on about people being afraid of losing their jobs to AI. I think that's less so now as people realize that AI can do certain things and other things it certainly can't. But as we've seen inflation come down, and inflation expectations come down, consumer confidence is starting to come off the mat. And Scott, while most investors have been dramatically crowded into semiconductors and memory, which is starting to roll over, and we can talk more about that, I think the real play into end of year is to start to bet on the consumer again in some of the groups like consumer discretionary, which has been left for dead, and even to a lesser extent, consumer staples, because if we get some volatility in the crowded trades, that's where people are going to want to continue to hide.
Well, talk about this rolling over effect from semis and the likes. I mean, what are your thoughts there? There's a little bit of a rotation going on. What's happening?
Yeah, that's been a core theme, and we've been saying for a couple of months publicly that we expected one or more of the hyperscalers to moderate their CapEx commitments in Q2 earnings. And we saw a taste of that. Meta kind of front ran that expectation when they announced a couple of weeks ago that they were going to sell their excess compute capacity versus use it internally. And for everyday listeners tuning in, translated into real world language, what they're basically saying is, we cannot get a good enough return on invested capital in our internal AI projects, improving their utility. So we're going to just sell this capacity at a commodity price and compete against other commodity providers. And what that said to the market was that maybe it's not as scarce as everyone thinks, and maybe the return on invested capital is not as high, which means CapEx commitments from the hyperscalers, and you'll see, will start to moderate. You're seeing token prices come down. You're seeing businesses that have invested heavily in AI get the bill in the recent quarter and say, this is a lot more than we expected. And they're looking for alternative models that are cheaper, token compute that are cheaper, and a reduction of uses where they're not seeing that return on invested capital. And that's why you've seen in the last week or two a proliferation of headlines related to open source and cheaper Chinese models that can do some of the similar things at a much lower cost. So the point is when you're buying a basket of stocks, in the case of semiconductors and memory, and you've been around long enough and a public figure long enough talking about these things, that memory and semis are cyclical. If you look at Micron's chart, every 4 years, there's a shortage of memory, management gets on and says, we're increasing capacity. They follow through on that promise just in time for demand to come down. Whether it was gaming, whether it was Bitcoin, whether it was the tech boom, the story is all the same. Because when things become scarce and the price goes up, technological innovation and survival demands that people find cheaper ways to do it. So Jensen Huang thought he had the world by the tail with GPUs, and then all of a sudden the market said GPUs are too expensive and too scarce. And guess what? DeepSeek came out and they said we could do this with CPUs. Let's focus on inference, and the same thing will be true with tokens, et cetera, et cetera. Necessity is the mother of invention, and there will be cheaper and better ways to maximize the benefits of AI in coming years.
Yeah, to your point, I was talking about this the other day, and I think that ultimately, as I drive through some of these back roads, highways, you see these massive, massive data centers being built. I'm like, you know what? I wonder how far away from we are from those things being the size of an air conditioner, because of the mainframes back in the 1960s and 70s versus what we've got in our hands today. Anyway, it's going to be interesting, and I appreciate you coming on, Thomas, because, Tom, we're going to kind of have you come back again from time to time to let us know what you think, because that was a great rundown. I really appreciate it. You're awesome. I'm sure our viewers are going to love you as well. Really appreciate you coming on, Tom. Tom Hayes coming to us from Great Hill Capital in New York right now. Thanks for being on the show.
And we're back, so thanks to Scott Shellady. And then finally, this was probably my favorite quote of all time in the Wall Street Journal. I've been quoted a number of times, very grateful for that. But this one was about PayPal. They picked up my post on X, and the author, Joe Stonner, said, Thomas Hayes, chairman of investment management firm Great Hill Capital, wrote on X that the reported offer undervalued PayPal given its strong free cash flow and improving margins. Even an offer above $80 a share would represent a steep discount to PayPal's intrinsic value, Hayes added. So that's that. And then moving right along, our quote of the week from Warren Buffett: you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. That's also a case in business. It's not the smartest, it's the hardest working and the best temperament and the ones that have the emotional control to persist in the face of adversity. And oftentimes there's a inverse correlation between the higher the IQ, the more emotional and less likely to stick through the challenges, where the Clydesdales that, tortoise and the hare, Aesop's fables, that just keep putting one foot in front of the other, eventually get to the promised land. So John Templeton: to buy when others are despondently selling and sell when others are euphorically buying takes the greatest courage, but provides the greatest profit. And then I want to thank all of our incredible podcast listeners who have been sharing the podcast. We've been doing this for 7 years. All we ask each week we do this for clients, and we've opened it up for the public to listen in, and they've made a tremendous amount of money off of our ideas over the years. And all we ask in return for those who can't afford to become clients, and most who listen for a while and make money off our ideas that can afford to be clients do become clients. But those who can't, just share it with one person that you care about who would benefit from this each week, because as long as the numbers continue to grow, we're going to continue to keep it open for the general public. And you can do that by just sharing it, or many people do it by going to hedgefundtips.com, clicking on the hat and ordering some merch, whether it's the hats, the t-shirts, the mugs, or the hoodie, and people will ask you, what's Hedge Fund Tips? And you can tell them and keep this machine going for a long, long time to come, because so far you guys have done an incredible job sharing it. But we can't rest on our laurels. Growth is the name of the game. So keep up with that. Keep sending in your pictures to info@hedgefundtips.com. Orders now outweigh pictures probably 30-1. Please send in your pictures. You could always ask us to take it down if you don't want it up in the future. I want to thank all the clients that came in this quarter, and all the clients generally. We had a ton of $5 million accounts come in. We had a ton of the $1 millions upgrade to 5 millions to get better terms. And we had one client, big shout out to Frank S. I'll keep his privacy there, upgraded from 15 million to 50 million to get the best terms. And I want to acknowledge Frank because I think Frank came in a few years ago at 2 million. So it goes to show you. And by the way, his timing couldn't be any better because he got like $6.5 million of PayPal at $43. So good job, Frank. I think you're getting it. You know, when everyone else was worried about PayPal, he throws in another 35 million. And of course, our first buy was a ton more PayPal, as it has been for many months here. So, all right, let's get down to data. I put this together this week. Actually today, this Jensen Huang quote. All of you know, I've been very cautious on semiconductors and memory for the last month or so, and I said this is going to crack, and we have positions that were in line with that viewpoint, and continue to have positions that are in line with that viewpoint. About 3% of equity, which represent, with expected value of 7x, and those are starting to play out. But I just want you guys to keep things in perspective, because it's always, people say it's different this time. They always say it's different this time. And I want to show a quote from Jensen Huang, the CEO of NVIDIA, who was also Jensen Huang, the CEO of NVIDIA in the 2000 timeframe. And his quote in the year 2000, right before his stock corrected 90%, was over a 1-year period from January 2002 to October 2002. Actually, in 9 months, stock fell 90%. His quote was, quote, "The explosion of visual devices has created a huge multimedia market. We are the best in the business, the most focused in the business, and the single best pure play of the multimedia in the world." Okay, so that's his quote. Just replace multimedia and devices with AI and GPUs. I'm not saying that the stock's going to crack 90%. I don't think this is going to be another 2000 type situation, but I do think that many of these semi and memory stocks have far gotten ahead of themselves by orders of magnitude. And even though we're in the mid innings of the AI revolution, or even early to mid, many of these stocks are pricing in everything has already happened, and they're going to have a mean reversion you're going to see many people, and you've already seen it. Last week, we talked about the people on TV talking about, oh, Micron's down 20%. How cheap can you get at 9 times earnings? Well, we covered that with Joel. Well, now it's even cheaper. So now it's down 30% instead of 20% for all those folks who advise people to buy down 20%, and it's going lower. So, read a history book or pay a hefty tuition. S&P returns surrounding midterm elections, 1934 to 2023. You tend to get some big midterm corrections of 20%, and then the rally off that is up 43%. It's interesting. I've been busy all day on the media stuff and everything else, and I have the stuff in the background. I looked up a couple times. I looked at the portfolio, which was up 3.5% ish, which is a lot of money. And then I kept looking at the CNBC screen. I realized, and the NASDAQ down like 2%. All the indices were down. Our portfolio's up. And it goes to show you, we've been positioning for stuff like this, and we've been seeing that on every red day. Our portfolio has been doing incredibly well. All right, value is extremely cheap, the cheapest since October 2020, in the 4th percentile. This is stock valuations calculated on a blend of price to sales, price to gross profit, price to economic book value, price to normalized earnings. And I strongly encourage you, if you're listening on Spotify or wherever you get your podcasts, for at least this section each week, go to YouTube and watch it, because you can't get the benefit of what I'm trying to tell you without the visualization of what I'm showing you. Next, memory industry has no middle gear. This is what I'm saying. This, for all intents and purposes, could just be a micron chart every 4 years. Like I was talking with Joel Elkanon, boom and bust, boom and bust. Shortage, overcapacity, just in time for demand to wane, bust. And it never changes. And the quotes are always the same at the top. This time is different, whether it was gaming, whether it was Bitcoin mining, whether it was multimedia devices in 2000, it always ends the same way. This is from Brendan Ahern, talking about Alibaba is poised for a 17x return on a $1.1 billion investment in CXMT ahead of the chipmaker's mega IPO. So we're, as shareholders of Alibaba, making $17 billion on this, and most people didn't even know we owned it, and there's hundreds of those. Alibaba is the cheapest AI play in the world, and no one's paying attention to it. Next, until they do. They'll all be paying attention to it at 250 to 300 when the same guys who just told you to buy Micron down 20% are telling you to buy Alibaba between $250 and $300 a share. Coming to a theater near you. Retail investors' cash allocation is at a low not seen since the 2021 peak, the 2020 peak, the 2018 peak, the 2000 peak, and the 1998 peak. So it tells you what you need to know, especially when it relates to those crowded areas, which is why on down days we're doing great, because we're positioned defensively, not because we're predicting the market, because that's what came into our filters as cheap. What comes into the filters as cheap when the market is frothy is defensive. That's why Diageo's up. That's why Baxter's up. That's why Hormel's up, et cetera, et cetera, et cetera. Change in margin debt is reaching 2021 peak, 2007 peak, 2000 peak. You can see it there, getting very close, certainly at 2007 levels. Excess margin debt growth, forward S&P 500 price change by margin debt growth. I don't even understand that chart, so let's skip it. Highest percentage of household net worth in equities, and even overtaking the peaks in 2000 and 1969. Lowest fund manager allocation to consumer stocks since May of 2006. We continue to pound the table. Discretionary, consumer staples. We covered that with Joel. Growth expectations rise to a 5-month high. That's on the most crowded trade. Good luck with that. Fund manager survey says low dividend yield greater than high dividend yield for the first time since May of 2017. They expect low dividend yield stocks to outperform high dividend yield stocks. Interesting. Which is usually exactly when the opposite happens. And dividend payers are going to start to get paid, which you're already starting to see. No hyperscaler CapEx. In English, buy stocks with dividends right now. If you didn't 4 weeks ago when we told you to buy a basket, start getting exposure. 61% of fund managers thinks there will be no hyperscaler CapEx cut in 2026. Good luck with that one. Bank of America Fund Manager Survey and sentiment, investor sentiment, the most bullish since February of 2026. Cash levels fall to 3.6 from 4.1. And 82% of fund managers surveyed long global semiconductors is the world's most crowded trade ever in the history of the survey, by the way. So good luck. Largest inflow into Chinese equities since December 2025. Nice to see that turning back around. Here's the Bank of America bull bear indicator that Joel referenced in my notes to him before the segment. Consumer discretionary has bottomed versus the S&P 500. You have not been able to buy consumer discretionary this cheap relative to the market since the COVID lows in 2000 and the great financial crisis lows in 2008. So skip it at your detriment. You've got to get exposure to the consumer here, whether it's through the VF Corps or the Gooses or multitude of other consumer stocks that we've talked about over the months. Small cap value outperforming large cap growth in 2026. This is exactly what happened during the tech peak in March of 2000. Same story. International will outperform US. Small cap will outperform large cap. Value will outperform growth. Here we go again. Consumer sentiment actually coming off the lows, as we discussed with Lou. S&P 500 versus tech, industrials, discretionary, healthcare, 30-day rolling correlations. So again, you got to go all the way back to COVID. Retail total turnover is running at record highs. They can't get enough stocks at the exact wrong time. Here's the all midterm election years model. We're tracking pretty closely. You get that strength into early summer and then some weakness into October before an end of year rally. SpaceX couldn't get enough over 200. Now it's below the IPO price. No one's talking about it. It's going lower. Generational transfer and free cash flow is taking place from the hyperscalers to the semiconductors. That is going to change abruptly. Deal track credit availability is going up. That's good for autos. US stocks beyond tech are starting to rally this year. Equal weighted S&P has outperformed for the first time since 2022. Amen. Hallelujah. Here we go. SMID caps could benefit, that's small and mid, from a broadening economic growth due to their higher domestic exposure, larger weight within industrials. We like that story. Earnings appear to be bottoming in the U.S. large caps when controlling for tech exposure. Earnings are expected to continue to grow at a pace reserved typically for recession recoveries. Actual buybacks falling down because of tech. They can't afford to buy them back anymore. Memory mania aborted, paused, or just resting. It's done. Chinese models have overtaken their U.S. counterparts in large language models by orders of magnitude since April of this year. Cycle composite for 2026. This is data going back to 1928. You get a little weakness in June and mid-July, strength, and then August through October, weakness again, which will help our defensives. So when the market gets frothy here, we want to add defensives going into the fall and then take those profits and buy some stocks that are going to be half off in October. Check households, checkable deposits, currency, okay. Price to earnings. So you can see here over time, price always follows earnings. Right now, the last period of years, price has outperformed earnings by some, but it will always revert back. Either earnings will move up to price or price will move back down to earnings, as we've seen all the way back to 1900. Net foreign inflows into U.S. equities. That's usually the exact time you want to be flipping to international. 2 of the 3 largest U.S. share sales ever happened this summer between SpaceX and SK Hynix. Daily drama within the tech sector. Truckload demand indicator rises to 64. So the real economy, you're seeing truckloads increase. That's very positive for the equal weight and the everything trade. Wall Street has lowballed S&P earnings for 13 straight quarters. Call to put direction ratio. By year-to-date, AI supply has reached 270 billion, up 99% from the full year 2025. Leveraged ETF assets under management, another sign of frothiness in semis and tech. Margin debt, again, above 54% usually leads to a short-term or long-term consolidation going all the way back to 1970. You can see it here. That's from FundStrat. Single stock net weekly buying is at its lowest since the COVID lows. Credit spreads remain tight. That's bullish for now. Panic index at 2-year low, so no one sees any risks on the horizon. Again, I've been saying this for months. Watch European sovereign credit in coming months. I think that's going to be more of the problem in the fall than semis and memory cracking. ISM by the way, semis and memory is going to crack, but the bigger problem is going to be European sovereign debt. ISM manufacturing PMI ticking up. That's good for the everything trade. Industrial capacity manufacturing ticking up. C&I loans ticking up. Credit expansion is good. July rate hike odds have plummeted since the inflation reports. Beginning of CapEx growth deceleration, capital spending year-over-year growth, the sum of Alphabet, Amazon, Meta, Microsoft, and Oracle actuals and consensus estimates. You can see peaked in Q1 of 2026 is now going lower and lower. High beta factor correlation. You can see this gets extreme before periods of consolidation. This was one of the factors that I said has been an impact on misleading earnings for tech. One has been the depreciation expense relative to the cash outlay is much smaller, which makes earnings look better on paper than they are in economics. And two is the other income versus total net income as a result of these companies holding positions in SpaceX and OpenAI, and those valuations being temporarily marked up dramatically and flowing through to net income is temporary and will revert, as you're already seeing with SpaceX. CPI coming down. China targets 60 trillion of retail sales by 2030. Alibaba is the toll taker. People forgot they actually have that side of the business. They're excited about AI now, but that's going to come back into favor like the Wall Street fashion show it always does. Russell 2000, that's small caps relative to the S&P 500, been turning up for the last year plus. That will continue. Correlations between the average stock and the S&P index fell to historical lows of 0.11. You have not seen that since the tech wreck going back 26 years. Okay, EV sales have sharply accelerated during the Iran conflict. Knee-jerk reaction there, which is good for Cooper Standard. Sentiment versus positioning. Consumer sentiment, record lows. Positioning, near record highs. I think sentiment is coming up. I think these are going to meet probably somewhere in the middle in coming months. Main Street sentiment will go up. Wall Street sentiment will go down. Back to school sales are projected to rise 14.5% year on year, surpassing the previous high set in 2023, which could be very good for consumer discretionary. U.S. momentum stocks drop, biggest drop since 2009. AI users' willingness to pay for tokens has fallen 20% since May. And that's the data for the week. Some quick headlines before we get to our article of the week. Alibaba's U.S. listed shares rise 4% after Qwen AI set to be integrated into Apple Intelligence in China. Vendor of choice. China internet stocks catch an AI lift as Beijing warms to tech once again. Xi to debut at China's flagship AI summit as U.S. rivalry heats up. Companies turn to Chinese AI models to cut costs. China new home price slump eases in sign market stabilizing. That affects Chinese consumer sentiment and the toll taker that Alibaba is for the Chinese middle class. China's monthly car exports surged past 1 million for the first time. Cooper Standard is participating in that growth. Stellantis shipments climbed 10% on growth in North America. PayPal shares surge pre-market on reports of a $53 billion takeover. That was yesterday. And there's the quote from Tom Purple Haze. That was my nickname as a golf caddy back in the day. They'd call me Purple Haze, which there was no correlation to that. It just sounded funny, but whatever. Exclusive. Disney's cruise ship fleet generated $3 billion in the last fiscal year, and the company plans to add 5 more in a $60 billion expansion. Discussed that with Joel. Highest return on capital business. Consumer discretionary stocks are coiled for a rebound, but which ones? Are talking about Etsy, because they like to talk about what's already gone up 70% in the last few months. And what they should be talking about is VF Corp and Canada Goose. Homes are in short supply in the U.S. How a new law could change the market. So that's going to help QXO, which we've been aggressive buyers of. It dropped down to $13. And why home sales are poised to pick up this summer. And Boeing records highest first half deliveries since 2018. Boeing unveils new 737 line as industry drives to boost output. Boeing expects to win certification for long-delayed jet models. 3 ways the LNG market could crack before winter. War, weather, and outages may still send gas prices soaring. That's Comstock Resources. U.S. small caps soar as investors look beyond big tech. Amen. Hallelujah. Russell 2000 on course for the best year since 2003. Which was after tech was cracking, helped by AI spending, tax changes, and low valuations. Morgan Stanley's Wilson sees profit boost for stocks beyond tech, poised to report strong earnings this season. Analysts expect S&P firms to post 23% jump in profits, which would be among the best readings ever outside of recoveries from major recessions. So I think we're going to see Main Street and everything trade win. Alex Karp is saying what every angry CEO is thinking about AI. Concerns over the power and insight AI labs derive from their business customers' data and decision-making, the magic sauce behind what makes a company successful. That's also going to have an impact on the most crowded trade in history. Blockbuster stock sales are threatening to overwhelm the bull market, so they're providing more supply. The ducks are quacking. They're overfeeding them. They're becoming fat ducks, and they're soon going to be dead ducks. Bank of America Fund Manager Survey, top 5 points. FMS allocation to consumer stocks lowest since May 2006. You want to get exposure there. Buy dividend stocks. No one wants them. FMS investors now the most overweight equities since December of 2024. Lighten up if you're overly in the frothy, crowded areas. Cash levels down, etc. Comstock Resources update for the newer readers. Here's a quick overview of the key drivers behind our thesis on Comstock Resources, a natural gas producer that we believe offers one of the most attractive backdoor ways to play the AI and data center build out at a reasonable valuation. While you're at hedgefundtips.com, click on terms. This is all opinion, not advice. Consult your financial advisor before you do anything. If you don't have one and you're wealthy, I know one who does a really, really, really good job. Comstock's first quarter delivered the 2 things a natural gas producer never wants to see in the same headline: production going down and capital spending going up. Volumes fell to 1,088. Oil and gas sales declined 16% year on year to 339 million. And the company spent $343 million on drilling plus another $55 million on midstream against just $192 million of operating cash flow, driving free cash flow to a $206 million deficit. There is no dressing that up. Those are ugly numbers, and while they made for ugly headlines, they told you very little about the underlying business. That's because a brutal winter storm forced wells offline, shut down frac equipment, and made roads impassable, delaying completions by weeks. As a result, nearly every well Comstock turned to sales came online in the final days of March. In other words, the company incurred the cost of drilling and completing the wells, but booked almost none of the associated production. Conventional accounting will call that a bad quarter, but it's really just a timing issue that reverses as the calendar turns. We are not investors in single quarters, and this is precisely the sort of stretch that separates the people who own businesses from the people who rent them. Management already has a line of sight to production rebounding 13 to 15% sequentially, with strong momentum expected throughout the back half of the year. As CEO Jay Allison put it on the call, quote, "I think we've turned the corner," end quote. Even with volumes down, per unit costs elevated as largely fixed expenses were spread across fewer units of production and nearly every headwind blowing in the same direction, Comstock still produced natural gas at a cost 43% below the peer average. That tells us the low cost advantage that drew us to this name in the first place is as strong as ever. Now for what actually mattered. While the sell side spent its time picking apart a weather-driven quarter, two catalysts fundamentally reset what this company is worth, and neither received the attention they deserved. On March 19th, the U.S. Department of Commerce selected Comstock's Western Haynesville to host the Texas Natural Gas-fired Power Generation Hub, a $16 billion facility in Anderson County, Texas. The project will be built and operated by NextEra, the nation's largest energy infrastructure builder and a Comstock partner since 2015. Once complete, it will include 5.2 gigawatts of dispatchable gas-fired generation capable of serving 5 gigawatts of large load demand from data centers and advanced manufacturing. Comstock has what is arguably the best seat at the table, carrying no construction obligation, no surface ownership, and no capital at risk on the build. All it has to do is supply the gas, and those volumes could approach 1 billion cubic feet per day by 2031. For context, Comstock produces 1.1 billion cubic feet per day this quarter. In other words, the federal government just parked a customer in Comstock's backyard capable of absorbing nearly everything the company currently pulls out of the ground. This was not luck, and NextEra certainly did not select Comstock out of the kindness of its heart. A project of this scale requires abundant natural gas reserves, pipeline and transmission infrastructure already in the ground, and close proximity to the site itself. Very few operators in America check all three boxes because doing so requires years of investing ahead of demand, a demand wave that has yet to arrive. This is exactly what Comstock did. While much of the industry was hiding under its desks as natural gas was grinding sideways at inflation-adjusted lows, Comstock, backed by the deep pockets of veteran wildcatter and Dallas Cowboys owner Jerry Jones, was busy signing 30,000 individual leases across what has grown into more than 540,000 net acres in the West Haynesville. Those assets sit squarely within the ERCOT, Electric Reliability Council of Texas market, with transmission infrastructure already in the ground, about 100 miles from both Dallas and Houston and 250 miles from the Gulf Coast LNG corridor. This is exactly what we mean when we talk about skating to where the puck is going, and this is what it looks like when the puck finally arrives. For the better part of the year, Comstock has been telling investors this moment was coming. Quarter after quarter, management discussed how large end users were increasingly looking to bypass the grid and work directly with producers through long-term supply agreements, noting that the phone had been ringing. The Power Generation Hub is the first tangible payoff from all that work, and we believe it is unlikely to be the last because you only need to look at what Chevron just did to see where the trend is headed. Chevron and Microsoft strike 20-year gas deal for AI data centers. Chevron signed a 20-year agreement to supply 2.67 gigawatts of power to Microsoft from new natural gas plants in West Texas, supporting a data center campus that will consume roughly as much power as 2 million homes while creating 400 million cubic feet a day of incremental demand for Permian gas. as the hyperscalers march toward a consensus $748 billion of capex commitments in 2026. For now, up 80% year on year. The single biggest constraint standing in their way is access to reliable power. They are no longer waiting for the grid to solve the problem and are instead going directly to producers, locking in long-dated contracted volumes rather than relying on the spot market and hoping for the best. This begs the question, who owns more natural gas in the Western Haynesville and sits closer to this demand than Comstock Resources? Nobody does, with nearly 807,000 net acres positioned squarely between Gulf Coast LNG terminals and the Texas data center buildout. Additional agreements with Comstock's name attached are a matter of when, not if. The second catalyst is one management flagged on the call and then delivered just 6 weeks later. During the call, management said the process of raising outside equity for Pinnacle Gas Services, Comstock's controlled midstream subsidiary, was progressing well and nearing the finish line. On June 15th, they closed the transaction. Sixth Street invested $600 million for a 27% non-controlling stake in Pinnacle, implying a $2.2 billion enterprise value for the midstream business. From Comstock's perspective, the transaction does everything you would want. Proceeds fully retire the expensive quantum preferred units, which carried a 12% dividend on invested capital, plus 80% of Pinnacle's distributions until certain hurdles were met at a cost of $445 million plus accrued dividends. The transaction also eliminates all of Pinnacle's outstanding debt, stripping $40 million of annual fixed charges out of the structure in the process. Pinnacle emerges debt-free. Comstock retains a 73% controlling stake worth $1.6 billion, maintains full operational control, and ultimately steps back up to 80.5% ownership once Sixth Street clears its return hurdles. Looking past the transaction details, the real headline is that an institutional investor managing $135 billion just put real money behind a valuation that implies Comstock's gathering and treating system, 246 miles of high-pressure pipeline, and 2 treating plants are worth $2.2 billion, all against a company with an entire market cap of only $3.8 billion. In other words, the pipes and treatment facilities alone are worth nearly 60% of the entire company. The market, meanwhile, remains focused on storage reports, weather models, and geopolitical headlines, which is perfectly fine by us. We've been buying it hand over fist. Traders are welcome to have the quarter while we take the decade. We were more than happy to take advantage of recent weakness, building positions for clients who came aboard after we initiated the investment and never had the opportunity to establish one because the secular story has not changed one bit. U.S. natural gas markets are structurally tightening as the LNG exports accelerate and industrial demand builds along the Gulf Coast. The United States is already the world's largest LNG producer, and shipments are expected to double by the end of the decade. Shell's latest output projects global LNG demand increasing 65% by 2050, approaching 700 million tons annually compared to the 442 million tons traded in 2025. There is the milestone that says it all. Then there's the milestone that says it all. Natural gas accounted for 36% of U.S. energy consumption in 2025, just shy of petroleum at 37%. By the end of the decade, natural gas is expected to surpass oil for the first time since 1950, when petroleum overtook coal. Layer accelerating data center demand on top of the LNG export wave, and you arrive at 3 billion cubic feet a day of incremental natural gas demand each year through 2030. At that point, the question stops being whether demand will materialize and starts being where all of that gas is going to come from. Comstock has positioned itself to be the answer. But no, go buy Micron up 20x. That's the answer. All right. The key point is the market is missing. The entire world is busy trying to pick the winner of the AI era, debating which model, which chip, which hyperscaler, and which shiny object will come out on top the next quarter. We would rather own the sure thing. Across the entire AI ecosystem, there is one certainty. None of it runs without natural gas. Not the models, not the data centers, not a single query. We will be we will happily own the industry's lowest cost producer, sitting on one of the best footprints in America, right alongside Jerry Jones, who controls 71% of the company and sees more upside in its Comstock stake than in the most valuable sports franchise on the planet. Now we're cooking with gas. So top 10 points. Here's all the decks from their calls, and you can see all the shiny pictures and all that stuff. 10 key points from the earnings. You can go through at hedgefundtips.com. Earnings call, we highlighted all the important things that you need to know. And now we get on to market sentiment. Neutral on the fear and greed index, which is more short-term than the Bank of America bull bear index, and so on. Basic materials earnings, top 30 weights. Estimates in the last 60 days went up 2.7 for this year, 2.68 for next year. IBD growth index went up 13% for this year, 20% for next year. Economic data, CPI and PPI came in much lower than expected. That's good for inflation expectations and the consumer. Earnings growth estimates continue to... actually, they've been pretty flat for the last 4 since the end of the quarter. So let's see what comes in during earnings in coming weeks. And now we're going to move to the question and answer, Ask Me Anything question from our incredible audience. So first question comes from Tom Gooder. He's asking about the multiple. Yeah, I'm referring to the PE multiple being low in that case. Ang Wu, Copart. I'm very interested in that. We haven't done anything with it yet. Matthias, Mule, Coloplast, CLPBY. CLPBY. All right, what do we got here? This is, they must have done a deal in 2020. Well, that's not huge. $23 billion, 23 billion. The hell is this? Net debt. Let's put this in dollars. $3.5 billion in debt. Okay. What do these guys do? Let's put this free cash flow in dollars as well. About $1 billion. Intimate healthcare product, chronic care, Yeah, I think if you can understand the products and their moat, there might be something to do here. Catheter business. Yeah, I think you just might be a little early on this, but I generally like the idea. $165 million of cash. I think your issue is the debt, is the balance sheet. 3.3 billion of debt, 165 million of cash with 769 million of receivables. Historically, it's been a good compounder. And let's just take a look at the free cash flow. Yeah, almost $1 billion of free cash. Yeah, I think this one, like Copart, warrants Copart we're already doing work on, but Coloplast, worth a look. Okay. Lee, why is CCI decline? Two things: overestimates of Starlink's impact on demand for cell tower usage, and inflation expectations were high, meaning rates would stay high, meaning dividend payers were out of favor, and the cost of refinancing their debt would go up. That's all going to reverse the second half. These are the type of stocks you want to own in our view. We bought more. Bob E. Bobby asks, how do you respond to people saying, quote, price doesn't catch up to fundamentals, it stays at the highest bid? These are a bunch of dumbasses day trading and blowing up their accounts. 12 months later, the ones giving this advice won't be on Twitter. Alex Carr, one of these days I'm going to learn how to express my feelings fully. Thoughts on PayPal? Bears saying free cash flow is inflated. Yeah, that guy's a dumbass. I read that comment. Next, JT Investor. What are your thoughts on CBiz? Let's see. Yeah, it's not the type of business I like to own, so I think it's going to probably work for you, but it's not super high conviction for me in terms of an easy double. I think you will get a double out of it, but it's not the type of business I sleep well at night. Very tough to predict. LeBron James asks, could you look at ARE? We like ARE. That's fine. That's a it's a life science REIT. We're good with that one. Again, it's going to be the same theme as Crown Castle. Boston Scientific, Adam, we've looked at it every week for the last 4 weeks. I think it's too early. That's a broken Momo stock. Everyone keeps asking about BSX. Every week I keep saying, not yet. INGN. Let's see. Oxygen concentrators, CPAP. Yeah, there are drugs coming out that people are going to be able to use instead of CPAP, but this is not the type of company I do anyway. It's negative free cash flow. You're speculating. It looks like it's cheap because the price is down, but it's still the cash flow negative. So these are, bet on black. If, maybe you get 5X. I don't like to gamble. I can't predict the future. I have no edge there. Casper J. Jasper J. Buffett came out and claimed he was the one who initiated the alphabet position. Thoughts? I was really disappointed by that, to be honest with you. I mean, there's an old saying, never meet your heroes. I I think over the long term, that will be probably okay, but I was definitely surprised by it. And yeah, I think we'll be buying it probably at half that price in coming years. So it is what it is. Thanks for taking this from Daniel Gray. Thanks for taking, but by the way, 1 out of 200 misses. God bless him. Thanks. If it wasn't for him, I wouldn't have a career. So that's that. Thanks for taking the time to do your podcast. I've been listening for 6 months. I've learned a lot. Wondering if you could take a look at LMB. All right. Well, welcome. Thank you. This is Limbach Holdings. So first off, welcome to the fold. Yeah, it's down 50% off the highs, but this thing is 30 bagger already. So I'm going to suggest that you avoid this, but let's just take a look at the financials to see if there's any relationship to price relative to the underlying fundamentals. And the answer is not really. Cash flow is down off of its 2023 peak. Revenues are up modestly and prices up 30x. So, and shares counts growing. What do these guys do? Building system solution, general contractors. So these guys have all grown with the AI craze. You've seen cat roll over. This will be next. Panos asks OI. Owings, Illinois. Yeah, it's a low return on capital business. Revenues have been really unstable the last few years. They are free cash flow positive, but they've got 4.6 billion in debt. $300 million of cash, $805 million of receivables, 4.6 billion of debt. And free cash flow of $38 million. Yeah, I don't really want to take that type of balance sheet risk for a potential double at most. So unless you know some catalyst that's going to turn around the business that hasn't been in existence for the last 2 decades, let me know. Sells glass containers to food and beverage manufacturers. Yeah, I like that type of business. I think I just need a much bigger discount. What do they? I'll bet they have a dividend. What's the dividend? What's the damn dividend? Oh, 0. No, you get nothing. And you like it. So don't buy that stock. Andrew Z, PSIX. Another one up 100x, pulled back. This stock's broken. PSIX. Went up 100x. Cash flow's reverting back down. Share count up. This is a good short. I mean, Power Solutions. Yeah, it's all AI wave nonsense. Sean Rogers. Does your buyout of PayPal change your game plan for the stock? No. See how it plays out. Dwayne D. First time AMA, long time listener. Thanks for all the insights. Blah, blah, blah. Australia is removing much of long-term capital gains benefit for investors without asking. What do you think about it philosophically? More tax is not good. Governments increasingly tax investment gains more heavily. Yeah, it definitely pays to own indices or great businesses over time and never sell it. Or move. Gaspard Bidot. Blah, 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 blah. All right, GBT. All right, so down 66%. Cash flow started to recover. Seems like it's rolling over. Same with revenues. Share count's gone mostly up since 2016. Margins are down a little bit off their peak, but not much. Multiples are super low. What do? Contrast media, medical devices, diagnostic solutions, MRI stuff. All right, what's the balance sheet? $135 million of cash, 448 of debt, cash flow. Probably worth doing a little work on. I like the healthcare theme. I don't like that it's in France, but not a bad. Okay, wondering if you're starting to look at Nike. Yeah, I like Nike. I don't like it as much as VF Corp. Ryan Long, Chinese export impacts CPS. They're benefiting from the Chinese volumes. Tom Corbett, Nike. Yeah, VF's better. Kyle M. T-Head IPO. Yeah, you're just getting all this value for free. It'll matter when it matters, the Wall Street Fashion Show, but that's why we own great things happen to people who own good businesses at great prices. And you don't know what the catalyst is going to be or when it's going to be. You just know that you have a margin of safety, and when it turns all at once. So don't overthink it. Whether this one IPOing at $19 billion or Ant IPOing at a gazillion dollars and we own a third of it, all those are free options. All you have to worry about is got to be in it to win it. Mark Geller. Asked about QXO. Yes, we bought more. Ernest Martell, Intuitive Surgical. Yeah, I've looked at that one. Haven't done anything with it. Not enough to get a double or triple, so we passed, but good business at good price, not great business at great price, or good business at great price, so it's a pass. Patrick Kelly, you'll make some money, but yeah. He's talking about using Goldman as a barometer for the market. No, that's silliness. Randy Gordon, it's a barometer for IPO paper. Very new to podcast. Great content. Ingersoll Rand. Welcome, by the way. No. You're a little late on that move. Yeah, this is just getting an AI bump. All right, next. Jared. Been a listener for almost a year. Thanks for sharing your knowledge. Been sharing the podcast with friends and family. That's why I keep doing it. Good job. Everyone at work seems stubborn on the AI trade, though. That tells you everything you need to know. Looking forward to getting some merch. Forward. Yeah, this one is, I have actually looked at this. This is a lot of risk and a lot of reward all in the same package. We saw some good trucking numbers today. I love your mindset on this. They've had to issue some stock. They do have a levered balance sheet. It's a cyclical, not super great business. There's some idiosyncratic problems with this, but in a personal account, would I take a 5% punt on this in expectation of a 3 or 4 bagger? You bet. And you have to manage it you got to treat it like a call option. So small amount of equity because you've got a levered balance sheet and you have a very tricky industry, but I think it's turning for the better. So I think it's worth a punt in the PA for sure. I couldn't put capital I'm responsible for at risk with something like this because it could go to zero. But if it doesn't, you're going to make a multi-bag, that's for sure. So size it accordingly as if you would a call option. So without an expiration date. I like that one, though. Good job. Chris Williamson, Flutter, gambling. We don't do gambling sites. It's just too crowded. And we covered that one a couple weeks ago anyway. Yeah. FLUT. Yeah, I mean, you could take a trade on this one. I personally wouldn't want to own it, but I could definitely see what you're seeing and probably makes sense for a punt in a personal account. Tim D. Oh, Vinay Desai using a fake name. Why isn't pizza getting a push with restaurants? It doesn't until it does. And then you get a buyout offer and you get bids. But the guy who's running it, I hope they don't sell it. I hope they actually run it because they'll catch the turnaround. He'll do what he did with Wendy's, with digital. They're hitting on all cylinders with that. Big fan. Appreciate your work. They won't sell PayPal for 60. I think we can agree on that. My concern, however, is that they'll sell it for 80, even though it's worth 150. What's your opinion on this? If they sell it for 80, I will be obscenely wealthy. You know, I'll figure out how to, you know, deal with my tears on board my yacht, wondering about that extra $70 I could have made if they didn't sell it. Mark Howard. Blah, blah, blah. Etsy. Yeah, we're not going to talk about positions that were I would say, yeah. So we're going to leave that one out. Michael Valchef. Yeah, we like Disney. I don't understand your question, but Anton Ellerman. What's something you believed 10 years ago that you don't believe anymore? Some of the greats are not so great. Luke Harris. What do you think of Realty Income Corporation? I don't know. Give me a ticker. REALTY. Oh. I don't know. What do I think of it? I think it's fine. I just don't think you're gonna make it double or triple anytime soon. Luke Harris. Marcel Bala. HPQ. Yeah, not enough upside for me on that. Alejandro Bustamante. No, none of them would be a position. I'll take a look at FOXF, just because we've been getting questions on FOFX since $90 a share. Keep saying pass. Now it's at $20. So has it become interesting again? This is, again, consumer related to rates. We have enough exposure to that. I do think it's kind of interesting now, but it's not something we would invest in, but I think it's something that could probably find a place in a personal portfolio. What's the cash flow looking like? Yeah, I mean, it's high risk, high reward. I think it's going to take a little time to build a base here, but if they don't go out of business, you're going to make a lot of money. That's all I can say. And with that said, we're done. So we'll see you next week, same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.